Hello, chart watchers, and welcome to this Thursday, September 19th, 2019 Market Watchers live show with your hosts, Tom Bowley and Julius DeKempenaar. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, it is the day after the Fed. I'm sure we'll be talking quite a bit about what that could mean going forward. But first, let's take a look at what's going on in the market today. Dow Jones Industrial Average extending the rally we saw in the last hour yesterday. Currently, the Dow up 93 points, the S&P 500 up 12, the NASDAQ up 40, and the Russell 2000 lagging a bit on a relative basis, up 7 points. 10-year Treasury yield moving lower, but I don't know. I'm a little suspicious about this move to the downside. I think we're going to rally back on the 10-year Treasury yield. We'll talk about that in a minute, but we are down 1 basis point today to 1.77%. Volatility index, it is down about 3% today, breaking to new lows. This is another bullish development for the market. As the volatility decreases, we tend to see lesser and lesser big swings in the overall market, and that tends to send prices higher. Technology leading to the upside today, trying to make breakout in September here to a new high. Healthcare, we haven't talked too much about healthcare of late, but if it closed where it is right now, it closes there today, will be the highest close we've seen since back toward the end of July. So healthcare starting to see a little pickup there. Materials also having a good move, trying to challenge those late July highs. Energy pulling back after we had the huge gap up on energy with crude oil prices shooting higher to start the week. We have seen energy pulling back. It is the weakest sector today. Among the industry groups, toys. We've talked a lot about toys, and I even mentioned this one to Bruce Fraser when he was on it from a Wyckofian perspective. And this breakout not only is a short-term breakout, but it's more of an intermediate to longer-term breakout. Toys really performing well. They bounced back nicely yesterday when money began rotating back in to the market in the last hour, continuing to perform well today. Renewable energy regaining leadership. Talked about this one back on Tuesday. I really like this symmetrical triangle breakout. We got that with some emphasis, I would say, on Tuesday, and now we're continuing that, confirming it to the upside. Software, this would be a big one. We've had a lot of consolidation on software after posting that high in late July. August was rough. September, we haven't really been able to push through those that August consolidation period. We're trying to do it today. A strong finish today would be awesome. Microsoft leading that push in software to the upside, also leading the Dow higher. Microsoft, the best performer in the Dow today. And then Seagate Technology. Now, Seagate STX did come out, had some news. They upped their Q1 guidance. This is what you get when you up your guidance. You go down 5%. I know it makes no sense, but it looks to me like with all of these hollow candles, the market was anticipating it. I think when we got the news, we gapped up a little bit. Probably everybody that hadn't gotten on board jumped on board, and that's a lot of times when you see the market reverse. We saw that, probably scared a lot of those at the top. I think Seagate looks pretty good here, even though it is down 5%. Raising guidance. They didn't up their revenue guidance, and maybe that spooked a few traders. But the fact that they upped Q1 guidance after this huge move to the upside, I think the pullback probably represents a good opportunity. All right, Julius, we're one day after the Fed. Of course, 2 o'clock yesterday, they came out, they gave their announcement. They lowered Fed funds rate by a quarter point. That's what everybody, I think, was expecting. At least a week ago, that's what they were expecting. I think it was starting to get a little bit more, 50-50-ish. Heading into the report, but the Fed did come through for the equity bulls. How are you doing today, and what do you think of the Fed here?
I'm good, Tom, and thanks for having me again. I'm getting a real regular here. All this talk about the Fed, yes, I look at it, but it's like probably like the newspaper, which I read like after the fact when the market is closed and see, what has been driving it. I'd like the market to talk. It's probably something you cannot deny, and I know you've been putting a lot of attention to it, and that's good because it should be in the investor's toolbox. I don't think major things have changed, and I remember a long time ago when I was working on a trading floor, I created a chart for the euro dollar and annotated that every time when the Bundesbank lowered interest rates to see what happened in the euro dollar rate. And when you do that over a long period of time, they seem to be non-events. You get a little hiccup during the day or maybe a couple of days around it, but then I've never ever seen that kind of stuff impact the longer term trends that is dictated by markets.
All right, I am going to disagree with you, my friend. I think it did have a big impact yesterday, and I'll tell you why. We're going to talk about this more during the show as well.
We will.
I do agree. The charts tell you everything, but the one thing that was starting to shift prior to that Fed meeting was money was rotating away from growth and into value. And I think part of it was the market's been disappointed so many times by the Fed in the last 9 months. We've had big drops after Fed meetings that I don't think the market trusted Powell and what was going to go on and whether or not we were going to get that rate decrease. What I saw in the final hour and 15 minutes yesterday was a rush back into growth stocks versus value. And so I think the Fed helped to maybe reestablish a little bit of credibility after their announcement yesterday. I think that the market wanted the Fed to be a bit more accommodative. They didn't get 50 basis points, although one of the voting members did vote for 50 basis point reduction. 2 voted not to move it at all. And of course, they voted as a group to lower it 25 basis points. But I think that was a pretty big deal. We're going to talk about that a lot. We got a lot of stuff coming up. I want to go ahead and get into the upcoming schedule and all. But Julius and I will have a great conversation about that. And I do also want to mention we have a poll running. So maybe you can chime in and let us know what you think. Do you think that what happened yesterday with the Fed, has that made you more bullish? Has it made you more bearish? Or was it exactly what you expected and you really don't have a difference of opinion today versus yesterday? Fill out that poll. We'll talk about that at the end of the show. All right, our upcoming schedule, you can see Grayson Rose will be on next week. He's going to be joining Dave Keller. That'll be an interesting conversation. I'm sure they'll talk about the upcoming fall lineup here on StockCharts TV. I'll be doing a workshop next Tuesday, the 24th. Don't know what I'm going to do it on, but tune in. I'll try to come up with something interesting for you. And then Dan Russo will be joining us next week as well. As far as today and what we're going to do, well, we've got the sector spotlight preview coming up later. We're also going to be talking a lot about the Fed today. So that's something that we want to pay particular attention to. I think that, looking at RRGs, looking at some of the different groups that benefited, I think all of that will be something that you'll find very interesting as we go throughout the show. 10 in 10, Merck & Company will be our first symbol today. Take a look at that chart, see what you think. I like the chart, but I don't like it as much as you might think. So that'll just be a little sneak preview there. But see what you think of the chart. We'll see if we agree or disagree later, along with 9 other stocks. Take a look at those as well. All right, let's get into the today's economic reports, because we did have a few out today. We had the initial jobless claims come in better than expected. September Philadelphia Fed came in better than expected. August existing home sales better than expected. August leading indicators matched expectations. So on the heels of getting a 25-point basis cut there in the Fed funds rate, we're also seeing some pretty good economic reports, which I find to be very interesting as well. Taking a look at the 10-year Treasury yield, I got something a little different for you today that I wanted to show you on this chart. So at the top is the 10-year Treasury yield. Notice the last 3 or 4 days after the huge move we had, we've been pulling back. I don't trust this move to the downside. I think the 10-year Treasury yield is going to go higher. And I think one thing that is supporting me, if you look at this chart down here at the bottom, this is financials relative to the S&P 500. Now, typically, if we're going, if the 10-year Treasury yield is flat or rising, it tends to benefit financials. When it's falling, it tends to create selling in financials. If you look at some of the big drops, even from back here where we topped in May and started moving down, you can see some of the relative weakness that took place. This isn't telling us the absolute performance of financials. This is relative to the S&P 500. Then take a look at the big drop we saw heading into early August, and look what happened to the financials on a relative basis. Now we start moving up, and we have a move to the upside. The other thing I thought that was kind of interesting, too, is as we put in this new low to start September, we were already starting to turn up. So in other words, if there were folks selling financials as a result of the 10-year Treasury yield moving down, well, there were buyers on the other side. In fact, more buyers. And what we're seeing during this pullback in the 10-year Treasury yield is once again buyers stepping up. Why would they be stepping up if Treasury yields were going to go lower? That's a question I have for you, and I don't have the answer for you, except that I don't think Treasury yields are going to go lower. I think the market is telling us that this is probably a temporary pullback. The other thing is look at the pullback here in the 10-year Treasury yield and compare that to what we've seen prior. Look at these big red candles. A lot of buying in Treasuries throughout the day. That, I think, is much more meaningful to the downside than these moves where we get gaps to the downside and we really don't continue that buying throughout the day. So I don't know. I'm kind of looking at this with an accommodative Fed, maybe money rotating back into the financials. This is going to be an interesting time going forward. I'm turning more bullish personally. And some of you probably think, how is that even possible? But I am very bullish. I think I'm going to be more bullish going forward. And when we get this breakout, and if transports can come on, that would add to it as well. But anyway, that was the 10-year Treasury yield look there. Quickly, the earnings reports, there were a couple out between last night and this morning. MLHR, Herman Miller, nice report there. Also, Darden Restaurants came out. So we'll take a very quick look here at MLHR. I really like this gap up. They did beat on their bottom line. You can see the stock trying to break out relative to its peers again. This was a stock that gapped up with its earnings at the end of June, doing it again this time. I would be looking for a turn back to the upside somewhere in this 44 to 46 area. This was the initial price support level. It may simply turn from here, might go back down, fill the gap, watch that 20-day. But I do like the report. I like the reaction. I think the relative strength here looks good as well. So those are, that's one stock that I certainly would be trying to keep an eye on. All right, taking a look at the, well, there was one other stock. Let's pull that one up real quick. Darden Restaurants, gap down with earnings. Now, when you look at the restaurants, Darden has not been one of the better performers. I think you've got a lot of better choices out there than this stock. And after earnings, it gapped down, not really showing me anything yet. I would find other stocks to consider. Microsoft. Microsoft, you can see making a breakout here and also relative to its peers making a breakout. Really strong action there on Microsoft. And then technology leading the action today. And you can see on an absolute basis, this is a longer-term 3-year weekly chart trying to make a breakout here. But look at the relative strength, technology versus the S&P 500. If we were getting ready to go into a slowdown in the economy, would technology continue to lead to the upside? Just recently at the end of August, early September, set a new all-time relative high. That doesn't smell to me like a recession on the horizon. So I like what's going on here with that. All right, scooter mover. I do want to just point out on the scooter mover today that I liked Danaher. I liked what was going on. Look at this spike here on Danaher's scooter. Went from 50 up to 75 here just over this week. And today it's taking another jump, and it's trying to make a breakout. It's one of the leaders within the medical equipment space. And so I think this one on a confirmed breakout today is very bullish. And for that reason, it's my scooter mover of the day.
Very good, Tom. Then I will take over from you and go over some upgrades and downgrades that we've seen today. Let me grab the screen real quickly. And on the left-hand side, you will see the RRG that holds the upgrades of today. And I thought it was quite funny when I pulled that up because they're all in the lagging quadrant. They were all red and they're all upgrades. So let's take a few of those stocks and see if we can agree or disagree with what our fundamental counterparts are thinking of those. And the first one that I want to look at is SWN, Southwestern Energy. It's deep inside the lagging quadrant. It has turned up. This is a weekly RRG, so we're looking at a little bit longer term trends. If I look at the chart that comes with that position on the RRG, then I think I will not be happy with an upgrade here. It's certainly not at the lowest point, but I think that the trend is really down. And what we're seeing here is a little hiccup. There is so much overhead resistance that I'll be very, very careful with buying this stock at the moment. The other one that I would like to look at is CP triple Y. So that's CP triple Y, because that is closer to crossing over. Let me position this one a little bit more so you can see where it is in relation to the other quadrants. So this one is almost crossing over, but look at this trend. That's a real massive downtrend. For me, as far as I'm concerned, this is a little hiccup in this downtrend that's in play for more than a year right now. We see a little bit of improvement on relative momentum, but this trend is still down. So I'd be very careful with buying this as well. If we go on LGND, and I've checked that quickly before the show, that is a massive downtrend. But what we see here is that this relative trend is leveling off, and it's not so aggressive anymore. And it seems to have returned or is returning back above this resistance level. So out of all these stocks, LGND, sort of agree. It's pretty aggressive, pretty early. But if I have to pick one or two out of this universe of upgrades, then I think that LGND would make the most sense to me, together with the other one that I picked here. That was CUG, Cousins Properties, and that kind of fits because real estate's been doing pretty well. So let's look at CUZ there. We see that relative strength has been bottoming out at support. It's picking up some relative momentum, and the RS ratio is at a level where it bottomed 2 times before in the last 2 years, and that coincided with these lows here. Just shortly after these lows, the market started to rally again. So, LGND and CUZ are sort of okay. I don't like them very, very much, but if you put a gun to my head and I have to pick two, then it's probably LGND and CUG. The final one on the upgrades, which I really don't think is worth an upgrade, is TWLO, just Twilio, and that stock just broke the uptrend. And if you look very carefully, you might see here like something that looks like a head and shoulder or a double top with the head, but this relative strength is rolling over. It has turned around, and you'll see that perfectly in the RRG chart, where the RS ratio picked up the uptrend in March 2018, and it signaled the end of it sort of like in August, late August, when we started to roll over and we're breaking these support levels. So Twilio is definitely not worth an upgrade for me. I'd be very, very careful with this stock. Now, the next set is the downgrades. There's quite a lot of downgrades actually at the moment here, and there are two here, SUPV, and the other one with the long tail is BMA. Let's look at those. That is a real good downgrade. I mean, look at the RRG, look at the tail. That's coming from far away. It's signaling that for weeks. So the downgrade's actually pretty late, in my opinion. And the same goes for BMA, where we have that other very long tail, and that's also breaking below that long-term support level here. So downgrade all the way. Then how much time? We can still do one or two more. So if we browse through all these stocks with downgrades, then this I don't think is worth a downgrade. Look at ATUS. That's actually a pretty nice stock. It's trending upward, relative strength's going up, RRG lines are both moving up. There's not too much history there, but what's happening this year is a very crisp and clear uptrend. We're coming out this massive consolidation. Downtrend was reversed. We're in the uptrend right now. I didn't see any reason why this should change, so I would stick with this, and I don't like that it's downgraded. And then one more. See me. Look at this Akamai. That's a very popular stock always. AM. Again, just broke to new highs, strong relative strength. We need to overcome some sort of resistance. RRG lines moving higher both, so that's all fine, no problem there. I don't like this as a downgrade. I'd see this as a very nice stock with a very nice uptrend. And this was it for the upgrades and downgrades. We're going to have a little break, and then we'll be back right after that.
Okay, welcome back, everybody. We're going to get into that sector spotlight in just a little bit. But first, what I thought we could do, Julius, is talk a little bit about the Fed, the announcement. We talked a little bit at the beginning, and, we had a little different thoughts on how we would approach what's transpired. And I'm going to be anxious at the end of the show to see how everybody else voted in our poll today to see whether or not it's really done anything different for how they're viewing the market. I did like what happened, and I want to talk a little bit about this first. So what I have up on the screen here first is the iShares Russell 1000 Growth ETF. And if you just look at it on the daily chart, you see, okay, it had a high over here in July, hasn't quite gotten back up there. And then if we switch over to the value, the iShares for the Russell 1000 Value ETF, you can see that it actually broke out above that July high. So on the surface, what I'm looking at here is money rotating away from growth and into value. And I talked about that a little bit earlier. I think heading into this report, especially, you can see the huge move in value stocks at the beginning of September. We go back and look at the growth, and it really hadn't gone very far in September. So there was a mass rotation. And my feeling about it is that the Fed has disappointed traders 3 different times. We had a huge drop in December of 2018 after a Fed meeting. We did it again at the beginning of May after their, I think it was April 30th, May 1st meeting. And then we did it again at the end of July as we took that swoon. And you can see it very clearly here on this IWF chart, the huge drop in growth stocks after that last meeting. So, and then here over, back in May, you can see the big drop. So I think what the market was doing is heading into the Fed meeting, it was rotating out of growth and into value. I don't think the market trusted the Fed, and I think that was the signal that it was sending. And what I have seen since the meeting, now we're only talking about since 2 o'clock yesterday afternoon, so it hasn't even been 24 hours. But what I have seen is that since that 2 o'clock meeting, since the lows after that 2 o'clock meeting, the IWF, the growth ETF, is up 1.65%. The value ETF, that IWD, is up 0.98%. So the IWF is up about 60% more in just the last 24 hours. Now, does that make a new trend? No. But what it does at least point out is the fact that maybe now that the Fed's behind, it's behind us, they've lowered their rates, they've talked about remaining accommodative if the need arises. I think that has encouraged traders to get back into some of these growth stocks. And if that continues, I think we've got a great opportunity ahead, especially if we begin to see a breakout in our major indices. And currently, we would need to get through about 3,030 or so on the S&P. We're at 3,017. We're not far away. And so that's one of the things I'm going to be watching going forward. Now, I know before the show, Julius, you and I were talking a little bit about maybe impacts that we were seeing internationally since the report yesterday or since the announcement. What does it look like on an RRG to you?
Yeah, let me grab the screen and talk you through a few things. Indeed, what we talked about before. Before we start, you started before I started the upgrades and downgrades about the financial sector leading into the Fed meeting and how that was doing, and I just highlighted XLF on the RRG, and what you see here is that, as you sort of highlighted, it started to improve leading into the meeting, and it still is moving to the right. So financials are doing very good on the back of this meeting, and especially on the back of the expectations, I guess I should say. So I'm with you there with the XLF. Now, what we discussed was to look at the international markets, and there is a predefined group with international stock market indexes. And if you bring that up, and let's make that a daily chart so we see a little bit more granularity and recent moves, what we see here is that this is a 5-day tail, so last 5 trading days. And we see that the Asian markets, Hong Kong, Korea, Japan, this is Russia, China, and this is Mexico, all rolled over. But the good news is coming from the commodity-based or markets that are very heavily weighing on commodities, and that's Canada, Toronto, and Australia, the all ordinary. So that was like in line with what we discussed on.
Mm-hmm. Yeah, and I would say too, when you look at this, I mean, if you think about what the Fed did by lowering rates, I think that was important to send a message on the dollar. I think if they had left rates unchanged, and one of the biggest problems I've had with the Fed not acting fast enough is that it's encouraged more buying of the US dollar. If the Fed is being much more hawkish than other central bankers around the globe, that's going to strengthen the dollar. And the problem with that is when the dollar strengthens, it lowers commodity prices. And so, or at least commodity prices on a relative basis underperform, which leads to more disinflation. And by the way, there was a question yesterday asked me about disinflation versus deflation. Disinflation is just a lowering of inflation. Deflation is when you actually go negative. But I think that the disinflation that we've experienced would become even more of a problem if the Fed didn't act. It wasn't about the economy. Everyone's saying, well, why are we lowering rates? The economy's strong. We've got jobs, unemployment rate's low. In my opinion, it has nothing to do with that. It's more about trying to keep the target level inflation around 2%, because the mandate of the Fed is to maximize employment and to stabilize prices. Those are the two things that the Fed is supposed to be doing. Maximizing employment is not the problem. Stabilizing prices is the problem. And I think when the Fed lowered and is showing that they're going to remain somewhat accommodative, I think that's important because it affects the pricing of the dollar, the direction of the dollar. And I think because they did show some accommodation there, I think that's why you're seeing Canada and Australia and some of those areas around the world that are more heavily influenced by commodities and what's going on there. I think that's why they're turning up.
Yeah, I just pulled up a chart, an RRG chart of the US dollar versus the other G9 currency. So with the dollar, it's the G10. The dollar is the center of the chart. And what you see is that the dollar is actually, all these greens, this means that these currencies have been strengthening against the dollar, and the euro is still strengthening against the dollar. But pound, Aussie, Canada, they have turned around. So versus the Australian dollar and the Canadian dollar, US dollar started to improve over the last 2 to 3 days. So we'll have to see how this pans out further. If I look at the euro dollar chart, that's still a downtrend. So that's positive for the US dollar versus the euro, because I expect this to go down further. So it's an interesting call there.
Yeah, and I think too, when you look at that, the dollar. Well, first of all, the what you're looking at in the upper right hand quadrant, in that leading quadrant.
Sure.
Sometimes you can turn down, go into the weakening, and then turn right back up into the leading. So we don't know.
Absolutely.
And so even though we're turning down the short term in terms of some of the momentum, I think the relative strength is still there in some of those other currencies. And I guess the question would be, what if the Fed didn't lower? And what if the dollar did strengthen as a result of that? What kind of an impact would that have on some of these the performance of some of these other countries and that are, heavily influenced by commodity prices? And I think that the Fed made the right move. And that's why I've been calling for a lowering. I would have been okay with a 50 basis point reduction, to be honest. I think the Fed was way behind the curve in terms of trying to inflate prices. And so I would have been fine with a 50 basis point. I know one of the presidents, one of the voting members of the Fed, did vote for a 50 basis point reduction, while two more hawkish members said to leave it alone.
Are you about to take out another mortgage if you like it so much?
No. Not at all. Not at all. I'm going to grab the screen for a second. I want to show kind of what happened yesterday on a sector basis, looking at an intraday 5-day chart. So here on this chart, this is financials. And what I found very interesting, when you look at all of the aggressive areas, I'll come back to the financials. Let's start with let me start with technology. So here on this 5-day, 10-minute chart, this is where the Fed announced yesterday at 2 o'clock. And I always say, be very careful doing anything in the first hour after the Fed reports. A lot of times we get these knee-jerk reactions in the wrong direction, and the market then turns and goes the other way. So initially you're thinking, okay, here we go. We're going to the downside. So everybody jumps in on that. And then after, you can see the XLK took out recent support, put in a false new low, and then came rallying back. That was a strong rally into the close. We closed at the high of the day. and we actually closed at the high of the last 3 days, even though we had been down in the first 45 minutes after the policy statement. We rallied back, and we've been strong again today. Now we can see that we're having some weakness. But my point here is that after the meeting, look at what happened to the technology sector. Then let's move on to consumer discretionary. See the same thing, basically. We put in a double bottom, but a very weak initial move on the XLY. Then we'll take a look at the industrials. Industrials making a new low after that policy statement. And then finally, communication services. These are the aggressive groups. And you can see that they took that immediate tumble to the downside with one exception, financials. Financials basically didn't go down, which I found very interesting. And I think what it tells me is that the market still believes, first of all, the market believes that this inverted yield curve is history now. And with the Fed becoming more accommodative on the Fed funds rate, the shorter term maturities, I think, are going to be held down to the downside. I think we're going to continue to see longer term maturities like the 10-year Treasury yield drift higher. And one other chart I'll show you is looking at the 10-year Treasury yield. Yes, the rates were cut, but the 10-year Treasury yield at 2 o'clock went shooting higher from 1.74% in change up to above 180 in the first 45, 50 minutes. Keep in mind, the bond market closes an hour before the stock market. But that was a very, very telling move, in my opinion, after that Fed meeting, that I think that this is going to be an opportunity for the financials. And when we look at that longer term chart on the financials, the XLF, you can see we've got this overhead resistance. But if we make this breakout, and I talked about this earlier in the show, I like the fact that the XLF has held up with the 10-year Treasury yield dropping the last 4 days, 3 or 4 days. So I think that this is an opportunity. I think if we get this breakout on the financials, it is going to add to the bullishness that we already have in areas like technology and in the consumer stocks. So I'm very bullish going forward. I think when you've got low interest rates, moderate growth, and an accommodative Fed, I don't know how you can be bearish, to be quite honest. That's, again, just my opinion. You're free to agree or disagree, but what do you think? I'm going to give you the last comments on this. We got a couple minutes. What do you think?
Yeah, I agree with your bullishness. I'm not sure if I became more bullish than I was before yesterday, but it certainly helps the cause. What I see is that there are more and more sectors breaking to new highs. They are usually the more aggressive sectors, so that's usually a good sign for the market. I just brought up the chart for the growth and value on an RRG. Is it okay if I grab the screen from you, Tom?
Yeah, absolutely. Show that.
Okay. So I actually brought this up, and I this is one of my what I call special RRGs, because it's not like sectors or stocks or stuff. This is different items. I most of the time use the Dow Jones indexes, the VA and the GR Dow Jones indexes, and you just talked about the ETFs, so IWD and IWF, and they show sort of similar patterns, not quite. And if you dive into the nitty gritties, you can see bigger differences. But here, the big picture is that value has been leading over growth. It sort of still is, but you see that value is rolling over and growth is picking up. And what I think is bullish is that despite the fact that we have value, which is sort of defensive rotation versus growth, and the market did not really go down, that I think that's a positive thing. If the market can hold up and go up, driven by value stocks, and as a matter of fact, also driven by some of the defensive sectors. If we go to the sector ETF on the weekly, you see that utilities, real estate, staples, communication services, they're all in the leading quadrant. They're starting to roll over right now, but over the last weeks, a little bit longer term, these are the sectors that have been driving the market, and the market didn't tank. It didn't really go down. So I think that's a bullish sign. And I posted a couple of RRGs today on some social medias, and I think this is a this is a really nice RRG because you see industrials, financials, energy, shooting to the right, and you see staples, real estate, and to a lesser extent, utilities and healthcare shooting to the left. So, I think there is a clear distinction here, and I agree that the growth seems to be picking up. The more aggressive sectors seem to be picking up. And today I wrote actually about XLI breaking to new highs, and it's very difficult to be bearish based on these observations.
Yeah, and I think that RRG chart's very telling. If we can get a breakout, what I like to see are the aggressive areas of the market leading on breakouts. I don't expect them to lead when the market's pulling back. I actually expect defensive stocks and sectors to lead when the market sells off. But when the market is breaking out to new all-time highs, if we do, one of the things I would be looking at is exactly that RRG chart that you're looking at right there. And you want to make sure that that relationship that you're showing there continues.
Yes.
We don't need to see all of those long tails going straight right, way out to the right, but we need those aggressive groups on the right-hand side of that RRG chart, either in leading or weakening, but still on the right-hand side. And I think if we see that with a breakout, I think that would confirm that this bull market is alive and well.
Yeah, we've got discretionary here. It's in weakening, but still at the right-hand side, so there is a good option that it will turn back up. The only odd one out is technology because it just crossed into the lagging quadrant on the daily chart. So it might be pulling back. It has been a very, very good sector, so maybe it's not strange that we have some sort of a break here. But that would be the one that I would like to see back up in the leading quadrant to give this market really breadth and a broad participation of all sectors.
One last comment I'll make, and this is my only real concern right now, is we're still in September. Tomorrow is quad witching day. A lot of times the market can be extremely volatile. It can pick up not just on quad witching day, but the week following. I can tell you historically, the S&P 500 since 1950, if you look at only September 20th through September 26th, which is tomorrow through next Thursday, the annualized return on the S&P 500 over the last 70 years during that period is minus 38.88%. So historically, it's one of the worst weeks of the year, and we are sitting up against a major all-time high record resistance. So if I'm going to throw one bearish stat out there, that is it. I think with options expiring, I would not be surprised short term if there's some manipulation that takes place. But I think if it does pull back, I think it'll be a great buying opportunity. All right, we're going to move in now to the sector spotlight. And what we wanted to talk about here today, Julius, is your new show.
Yeah.
We've got an exciting fall lineup that is beginning on September 30th and into October. So basically, it's the start of the fourth quarter. And there are a number of new shows. Dave Keller, who's been hosting here this week and does a lot here with us on Market Watchers Live, he's going to be hosting a daily show starting at 4 o'clock Eastern every day called The Final Bar. And Julius, you also are part of the fall lineup, and you've got your own show, Sector Spotlight. So why don't you tell everybody a little bit about it?
I am. It'll be starting on Tuesday, October the 1st, and from then onwards, it will be every Tuesday. We'll be airing live at 10:30 Eastern, 30 minutes. And I'm super nervous, Tom, because now I have to do it on my own, and I don't have you to cover my back when I run into trouble. But we'll see how that goes. I'm nervous and excited because it's good fun, and I got a chance to promote sector work and RRG on the back of that. I know that I'm known for all the RRG stuff, but quite frankly, I do a bit more than just RRG. RRG is a tool that I use. It's a tool that I developed. I think it's a great tool to show people how sectors are moving, what the trends in sectors are, but it's not the Holy Grail. There is no Holy Grail. So even though I would like to tell you that it's the Holy Grail, it is not. But we will be using it a lot. And I've been asking people in a blog and a few prior appearances on Market Watchers Live to write in if they have any ideas or stuff that they want to talk about, because what I would like to do is make this show as interactive as possible given the setup that we have. And the reason for that is that I used to work as a researcher in various positions. And one of the things that I absolutely hated was when I had to write this like weekly report. And I am not a day trader. So my view is sort of a little bit longer term, like swing trading, a couple of days, weeks, but, usually a little bit longer term. And when you have to write a weekly report on the same market, sometimes things don't change in a week. And I hated it when I was writing the same comment in different words from week to week. And I told myself to not do that again. So I would like really to ask participation of all the people who are listening or reading my blogs and stuff. If there's anything that you want me to discuss, bring it up, because I at least know there is at least one person who's interested in the stuff that I'm talking about, instead of just me babbling about things that I think you are interested about. One of the things that we want to go try do is bring up the Slido chat in the program. It's going to be an experiment. We do it right forward. I'm not sure if we can do that right now. If we do, then I'll see it appearing on the screen. But if we don't, then we're going to do that in my show at the time. The reason is because I can then actually talk to people and see what they are writing. So if I look at, I usually do that, and I did that today as well. One of the questions is if I can show how to display the two charts side by side. It's actually the person who's writing that says it again, because I've been doing that a long time and many times. It's really simple, guys. It's a Windows and a Mac trick. Basically, what you see here is two browsers. And you can just drag them to the right and it snaps to the left-hand side, or you pick this one and you snap it to the left. And you can also do that with your Windows and then right arrow, Windows left arrow. That's really a Windows trick. We can talk about this type of stuff. Another question that came in is how I measure momentum on a stock. Is it rate of change? Yeah, if I measure it on a stock, it's rate of change. But I think that the person in question, Alvaro, actually is referring to the momentum on the RRG. And that's actually an algorithm. It's based on rate of change. It's based on momentum, but it measures the rate of change of the trend. And this gives you a little bit of a sneak preview, because in the show, we will have from time to time sort of short educational snippets and ideas, maybe based on questions, because then it's a good idea, because then we actually know that people are listening. For the big picture idea, what I'd like to do, because the feedback that I've had so far, people want to have education. Yes, we're going to do that. Tick that box. They want to have longer term views. Yes, we're going to do that. Tick that box. And they want to have trade ideas. Yes, we will try to tick that box when it's possible. So stuff that I have on my list, items that I can work with. I will definitely do a quick look back at every show, what happened over the last 5 days since the previous show. And then my big picture idea is to establish a longer term picture based on weekly RRGs every month. At the first show of the month, I want to do a longer term version of RRGs and views, etc. Maybe bring in some monthly charts to basically establish the longer term framework. And then in the weeks after, the 3-4 weeks after that show, just build on that framework of the longer term and zoom in on the price action and the relative action of these sectors, and maybe do a deep dive into an individual sector at various members, and from time to time look at what I call special RRGs. And we've had one earlier, that's the one with the growth and value. I've been working with breadth RRGs. We can do the asset class RRGs for our longer term picture. We've been looking at the currency RRG. So these are like the specialties that we can talk about. And I do a lot of research work like what if on RRGs. That we cannot do that on StockCharts yet, but I do it on other platforms and in my spreadsheets and stuff. Like what happens if a sector or a stock moves from quadrant A to B, from improving to leading? That kind of research. If I've got anything interesting to report, or if you have any questions, Julius, could you look at, if this, I've seen this and this happening, could you have a look at that? And I can run it through various systems, and we can discuss the results of that kind of research on the air. And I hope that we can basically work together to make that a super interesting and interactive show. So yeah, that's I think the big picture and stuff that I like to cover, Tom. And you know, what can I say? We're just gonna dive in head first on the 1st of October and take it from there.
All right. Well, let me just say one thing. I have no questions about your show. I'm not worried at all. You might be worried and nervous, but I'm not worried at all, because I know from doing Market Watchers Live these past couple of years and having you on the show how valuable the contributions you've made to the show regarding RRG and your analysis work and so forth. And I think this is going to be a huge windfall for all of StockCharts listeners and viewers to get this on a regular weekly basis. I actually think a weekly show is perfect for, you know, I do a lot of RRG analysis. I'll do price relative charts, you know, looking at the intermarket stuff. And I tend to do that on about a weekly basis. I think I would agree. I mean, you know, I've been writing a daily blog, Trading Places, for the last 4 years. I think getting in and talking about weekly charts or rotation every single day would get really, really stale and boring. But weekly, a lot changes, and especially if the market makes a breakout or it's pulling back or there's a big announcement, knowing where that money is going is incredibly important in trying to determine the future direction of the market. At least through all of my work, I think it's incredibly important. So I just want to point everyone to Julius's show, Sector Spotlight, Tuesdays, 10:30 a.m. Eastern. Is that right, Julius?
That's right.
All right, so 10:30 on Tuesdays. I'm going to be doing Trading Places live Tuesdays and Thursdays. So, and that's from 9 to 9:30. So I'm just going to say Tuesdays is must-see TV for sure.
Yeah, you're going to warm them up, and I can slam dunk it in then, right?
Absolutely. I'm going to throw you an alley-oop, and you just slam it in. That'd be no problem. All right. Well, we're looking forward to that, my friend, for sure. Really
cool.
Looking at the fall lineup. It'll be awesome. Everyone should check that out. All right, let's go ahead and jump into the 10 in 10. I know the first stock today is Merck. So I'm going to jump right in and take a look at this chart. And I said earlier that I'm not going to, you know, be a huge supporter of Merck. I will tell you this. It's in an uptrend. I think it's going higher. My problem with it is I think we're in a bull market. I think a lot of things are going higher. The question is it going to outperform the S&P 500? Because I want to litter my portfolio with stocks that I believe are going to outperform the S&P 500, not with stocks that are just going to kind of go along with, you know, for the ride. So when I look at the chart on Merck, I see a stock uptrending. I see sideways consolidation, which I expect to be resolved with a push to the upside. If I go over to the relative chart, this is where I have my problem with it. When you look at Merck relative to the S&P 500, it set a relative high back in, well, really to start 2019 or just before the start of 2019. And now here we are relative to the S&P 500. We haven't outperformed. We're starting to turn back up, but September's not been great. I just see a stock that's going along for the ride. And like I said, I just don't want those stocks. Pharmas relative to the S&P 500 have been downtrending all year. And Merck is one of the better stocks within the space. So if I was saying, okay, I just want to diversify. I don't care if a group is not outperforming right now. I want to be diversified. I need a pharma stock. Then yeah, I think Merck fits that bill, pays a nice dividend. But if I'm looking for strength across all areas of the market and I'm looking for outperformance, that's where I have the problem with Merck going forward. So I like the stock. I just don't think it's going to be an outperformer.
Cool. And the next one up is LDOS.
LV?
LD, Leidos Holdings, Lima Delta.
Yep, I like this one. I like the breakout on a relative basis. The huge move it made in August. We're coming back up here in September on a relative basis. It's not in a great group. So anytime I get a leader that is not in a great group, I just want to make sure I have my stops in play in the event that the stock begins to underperform. So here is what I was talking about in terms of relative strength, relative to its peers, and then down here relative to the S&P 500. I think that it has now put in a double bottom, and that was in August and then again here in September. And you've got the 50-day moving average just above that level. I think 82.5 is kind of my line in the sand, given the fact that this has not been a great group. I think stock overall looks really good. And for now, in the short term, I think it's in a range 82.5 to about 88.5.
All right. Next one is KTOS, Kratos Defense.
Yeah, I haven't looked at this one in a while. It was a big favorite of mine until we got this big drop at the beginning of August. It's starting to come back, and I really do like the defense stocks. So this is one that, fell out of favor in terms of relative strength, but it's starting to pick back up again. Higher highs and higher lows. Volume is still strong. If the volume was light, I'd look for something else. The fact that the volume is strong, I think what I would do is simply watch one price level, and that would be $20. There was your pullback. Here was your reaction high. We went back, put in a higher low, and we broke out, supported by volume. Now that rising 20-day moving average is sitting there. I think as long as you stay above $20 on a closing basis, I'd be okay holding KTOS.
All right. Next one is APPS, APPS, Digital Turbine.
Yes, this is a small software company. I actually own this one. It's beginning to show some strength again, or at least it was. Yeah, it's starting to come back off those lows. I just see a stock that's trending higher. And when you look at the relative strength, it had huge relative strength in August. It's pulled back in September, but we got to give it a little bit of leeway to the downside. I think software is starting to make another push here to the upside. A breakout would be bullish there, and I like the volume trend. So I think on APPS, because it is in a strong area of the market, I think as long as it holds about $6, that's a level I pointed out quite a while ago, probably a few weeks ago. I think as long as it holds there, we're fine. I would look maybe for consolidation here. And if you say, well, we're sitting at almost $7, I don't want to give it all the way down to $6. I would simply say, well, you don't want to take risk. You want to be out of stocks like this because it's a volatile stock. It could go to $6. I think eventually, though, the next big move will be a breakout above 8 before it's a breakdown before 6.
Cool. Next one is one of my favorites, XLI, the Industrials ETF.
Yeah, I think the industrials are really beginning to pick up, and I like that. Industrials and financials, people forget, these were the two leading groups from late 2016 through early 2018. It's all been about consumer stocks and technology as far as leadership goes the last 18 months, along with some of the defensive groups as we've consolidated. But this was a group that did very, very well. I'm just going to point out the overhead resistance here that I think is being cleared. But this was a group that was performing extremely well. I love these hollow candles. Even with the gaps to the downside, you can see buyers continuing to come in. I think the XLI goes higher, and I think this is one of the reasons why the market overall goes higher. I like it.
Cool. And the next one is a stock that I was introduced to very recently by my daughter. It's actually PINS, Pinterest.
All right. Did you buy it?
No, I downloaded the app.
Oh, I want to know if you bought the app. A lot of people have downloaded the app. I want to know if you bought the stock. All right, well, you got gap support, and it looked like it was being violated here off this downtrend to start September, but we did rally back. So now what I would say is you've got these two levels that I would really watch to the downside on Pinterest. You are in a bear flag. So to me, I think it's really important that before you break down to the downside, that you break out to the upside. So this level, if we break down, can't get through the 20-day, and then we come back down again and break down, I would be really careful with the stock. Otherwise, if we can get the move back to the upside, take out this reaction high, get above these moving averages, then I think we have a different story.
Cool. SunPower, SPWR. I'm looking at that on an RRG. I'm curious to learn what you're thinking about it.
Well, I love renewables, and I love the stock. I think the
me
gap
too.
up, pulled back, love that hammer on the gap support. Now it's rallying again. I think we're going to break out. This renewable energy has been the strongest industry group in 2019, and I think that it's beginning to pick up. I talked about the breakout of the group out of that symmetrical triangle. So I'm going to be looking for stocks that show strength in this area. I think SunPower is one of them. So I would be a fan here.
Yeah, it's inside improving and a strong RRG heading. It's about to cross over in leading. So yeah, absolutely right. Next one, DVA, Delta Victor Alpha.
Yeah, after we both endorse SPWR, it's going down. You know that, right?
Of course. That's only a short-term reaction.
Yeah, I mean, we're getting the breakout, but we're not holding it. That's a little bit of a problem. It's healthcare providers, which in the healthcare space has not been great. I really want to, because of that, I don't want to go back and turn back down to new lows. See this low where we came down and tested that 20-day? I'd be watching that closely. You got the 50-day just beneath that. I'm going to say 57.5, 58 would kind of be a line in the sand for me on this stock, because it shouldn't be breaking back to the downside if, in fact, it's going to outperform the market. So I'd be a little careful with it. So far, okay, but I would be watching it closely.
Excellent. Next one up is PAYS, P-A-Y-S, PaySign.
All right, this is in the specialty finance group, and I tell you, the group overall has been pretty good. Relative to the S&P, it's been pretty good, and this stock is falling apart on a relative basis. I don't know why, but look at the volume coming in. I think the combination of volume selling and relative weakness is something I would not touch. I have no idea what's going on here, but I think there's distribution taking place. And so for me, this would be something that I would completely avoid as we go forward.
Very good. And then to finish it up, SAIA, SAIA Incorporated.
All right. SAIA. Oh, wow. Yeah, got a great move to the upside. A little lighter on volume. It's okay volume in terms of, I'm talking about liquidity. The volume trends are very strong. Huge move up. I love this gap with the heaviest volume of the year, taking out all of this consolidation. That is generally a very, very strong sign. When I see it something like that, I always refer to change of character on a chart. Well, we had a downtrend, we sideways consolidated, massive volume and a gap up above resistance. That tells me that we have got a change of character, and you can see what's happened since. I think it's a great looking stock. And that is
very good.
10 in 10. I tell you, we got a minute. Do you want to pull up a RRG? Did you have a chance to do an RRG on these, Julius?
Yes, I did.
What do you think? Give us a second.
Let me quickly grab that here. So here we are. This is the RRG of the stuff that we just discussed. Let me quickly browse through them. So here is the SAIA. It's on the right-hand side. It's the strongest in the group. The Vita rolling over, not as good, but still strong. Kratos, that's a really nice one. It's going into leading and moving higher. XLI we discussed, super strong. This one is, I think, the one that I like best because of the rotation that it's going there. And then we have a bunch that are inside lagging. So it's PaySign going further to the left. I really don't like that one. Pinterest curling back up. Not fantastic, but improving. Probably the best one inside that one. Apps still moving too far to the left, not at a positive RRG heading, so I wouldn't touch that one. Merck getting there, not fantastic, probably in line with what you said. And then Leidos, very close to the benchmark, not massively interesting there. So for me, SunPower is the one that I would like best of this group.
Okay, yeah, I would agree with you. I think there are some others in that renewable energy space that are actually better. But I would simply say that, it's part of one of the best areas of the market. And so that's something I think we can build on going forward. All right, it is about time to wrap up. I do want to say that we had that poll, and I do have the results here. I just wanted to say that 66% said no, it's exactly what I expected. There you go. 27% more bullish, 7% more bearish. So I think the majority is kind of like where you are, Julius, just thinking that, okay, it's kind of what we expected, not really a big deal.
Yeah, I guess.
Yeah. All right, well, we do have to wrap up. It was fun having you on the show, Julius. Definitely check out Tuesday, October 1st for Julius's new show, Sector Spotlight. Do want to thank all of you for being with us today. Remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody, and we'll see you back here tomorrow. Happy trading.